All right, thank you, Chelsea. Glad to be here this afternoon. Thank you for allowing Southeast Bank to come and participate with you guys and share some information. I'm also joined by Julianne Morgan. She's with Southeast Bank also. So we are out of the local branch here in Chattanooga, downtown Chattanooga. So we work out of the bank branch, and we also have a student loan department that is housed out of Knoxville. And so we'll be sharing some information about the student loans and repaying the student loans. So if you guys have any questions as we go through the slide presentation, feel free to put it down in the chat, and then we'll have a session some time afterwards to ask any questions. And if me and Julianne do not know the answer to any specific question you have, we promise we will get you with the right individuals in our student loan department and get you the answers that you guys are looking for. So to kind of start off, we want to kind of tell you a little bit about Southeast Bank. Some of you may be familiar with Southeast. We just recently opened a branch in Chattanooga, but we are, let's see here. We are a full service bank headquartered in Farragut, Tennessee, with branches, about 14 branches, and a total asset base of about $2 billion. And this is the location of all of our branches. So kind of how we got started, we're actually a fairly new bank, about 10 years old. So prior to 2008, we were in the business, our holding company was in the business of originating student loans. And as we would originate student loans, they would be under the federal guidelines, and they would be insured and backed by the Department of Education and owned by the Department of Education. Well, the administration in 2008 re-regulated the student loan industry, and all the private lenders who were originating student loans basically had to kind of change operations. So the government said, hey, if the Department of Education is going to own these student loans, then we are going to originate them ourselves. So Southeast, along with a bunch of other private lenders, had to change operations and figure out something else to do. So back in 2008, in the economic crisis, a lot of banks were struggling. And so we decided to apply for a bank charter in 2008, and we were able to purchase a small bank of about $120 million there in Cookeville. So you can kind of see the two little branches there in Cookeville. And by doing that, it allowed us to go and operate as a bank throughout the state of Tennessee. And in 2012, we bought a bank called Southeast Bank and Trust. And that's kind of where we got our name from today. And that bank had locations in Athens and Ottawa, Cleveland, Decatur, Dayton, Spring City. You can kind of see there. And then over the course of the next several years, we opened branches in Knoxville. And then 2 years ago, the leadership team decided, you know what, we want to really grow the Chattanooga market. And so we opened a branch in downtown Chattanooga. We're in the Liberty Tower building, if you know where that is. And me and Julianne came on board with Southeast 2 years ago to help grow and create the foundation for Chattanooga. And hopefully in the next few years, we'll have 3 or 4 other branches expanding in Chattanooga. So that's kind of the where we came from and the Southeast Bank side of things. We have originated over 1.7 billion of private refinance student loans through its LFI division. And what is LFI? So LFI stands for Education Loan Finance. It is a division of it is a division of Southeast Bank. And so it handles the refinance of student loans. So we established this in 2015. If you remember, what I said back in 2008, 2010, we had to get out of the origination business. But in 2015, we got back into the student loan industry to design to assist borrowers and private student loans, help them refinance student loans, offer some flexible products both to them and the parents. And as I mentioned, this operation center is in Knoxville. So you hear a lot of the slide presentation, me talking about LFI. That's what we call the education loan finance part of our bank. So we're going to talk about the CARES Act. Some of you guys may be familiar with the CARES Act and its impact on the student loans. So 1 in 4 American adults have student loan debt. Right now, there's about 44 million adults that are student loan borrowers in the U.S. And for the average undergraduate student, that is $25,000. They leave school with $25,000 of student loan debt. And if you take that 25,000 times 44 million, that is a big, big number. So that's about $1 trillion of student loan debt across the United States. Now, if you're looking at someone with a graduate degree, they average about $57,000 in student loan debt. So you take that number, double it with the number of with $44 million, and you can see how huge the industry is in student loans and the amount of debt that U.S. adults carry once they get out of school. So student loans, I'm going to talk, it's basically split up into 2 separate categories. There's a federal category and there's a private category. SouthEast Bank falls under the private category as far as a private lender. Under the federal, and this is probably something that you guys, anybody who has student loan debt is probably more familiar with, but there is 2 programs. There's the Federal Family Education Loan Program. It's called the FELP. And then there's also a direct loan program. And under the private, there's student loans as far as to students in school, directly to students in school, and then also refinance. When students get out of school, they have 6 or 7 different student loans. They can look at refinancing with a private lender to help lower their terms. So federal loans make up about 90% of all student loans. So every year there's about $100 billion in student loans that are processed. So 90 billion of that is from the federal side, and 10 billion of that are with private lenders such as LFI and SouthEast Bank. So what makes up the federal student loans? Again, it's this FELP. It's the private lenders. This was discontinued back in 2010 once the student loan industry was regulated. But just because it was discontinued doesn't mean that the students weren't able to do away with their student loans. So anybody prior to 2010, if they had student loans under the FELP program, then they're still continuing to make payments on that program. And then there's also the direct loan program, which these are probably more familiar to everybody. So the Department of Education provides 4 different types of loans: subsidized, unsubsidized, direct plus, parent plus, grad plus, and then also the federal government offers a direct consolidation of loans as well too. So on the private side, this is the private lender. It's not part of the federal government. This is where a student may go to a bank. They may go to a private lender and say, "Hey, I need to get some money for school. I only qualify for X amount on the federal side. I need more money." So a bank or a private lender would give that student some additional money to cover the cost of attending school, and then also refinance. So this is the route that I actually went when I graduated. I'm probably going to date myself here, but I graduated from Tennessee Temple University in 1999. So was located there off of Highland Park. Of course, the school's no longer there now. But when I got out of school, I had 6 or 7 different loans, totaling probably about $35,000 that I still had to pay back. I was paying probably $50 a month on each one of those. And so I went to a private lender, such as LFI, and got a consolidation loan, combined those 6 or 7 into one loan. So it allowed me to lower my monthly payments and allowed me to stretch my term out to something that was a little bit more affordable for me once I got out of school. So you see this a lot once students get out of school, looking at refinancing to try to get some lower rate and better terms through a private lender. So the CARES Act, going to pull a little bit of information out of the CARES Act here. What is it, and how does it impact me, or how does it impact you with regards to repaying your student loans? So what is the CARES Act? So CARES basically stands for the Coronavirus Aid, Relief, and Economic Security. So that's where you get the CARES. It is a $2.2 trillion economic stimulus bill that was passed back in March of last year in response to the pandemic. And there we could talk probably 2 or 3 days on what all is involved with the CARES Act. But we're just going to pull out information, a couple bullet points with regards to student loans and how it impacts you. So the CARES Act suspended loan payments and temporarily halted collections on defaulted loans and set interest rates to 0% on loans owned by the Department of Education until September 30th, 2021. So originally this was September 30th of last year, and they decided to extend that to September 30th of this year. There's no, right now, we do not know if that's going to be extended beyond this date or if it's set to expire. But basically, if you have a student loan that is owned by the federal government, Department of Education, they suspended those payments. So you have not been able, or you had had to make payments for the past year, and your interest rates are zero. So what does it mean that your interest rate is zero? So basically what that means is during this course of this time, since March of last year, your student loans, even though you're not paying on the student loans, they are not accruing any interest. So that's big. So even though your balances are not going down, you're not accruing any more interest. Now, once this is lifted on September 30th, if it expires, then at that point, your interest rate will go back to whatever it was at the beginning, and you will start accruing interest, and you will start having to make payments on those student loans. All right, the CARES Act relief only applies to the federal student loans. So if you remember, we have federal and private. So if you have refinanced your federal loans with a private lender at some point in time, then the CARES Act does not apply to you. So the federal student loans, just kind of a recap on that, applies to those two different programs. The FFELP program, and not all loans on the FFELP program are eligible for the CARES Act, but the FFELP program and then any direct loan program, those four right there with the Department of Education applies to the CARES Act, and loans are halted for right now, or payments are halted right now, excuse me. So something else, another bullet point in the CARES Act that a lot of people may not know about. It's not talked a lot, but your employer can contribute up to $5,250 to an employee's student loans, and the employees will not have to pay taxes on that, but only if these payments are made by December 31st, 2025. So what does that mean? So basically, when you get your paycheck from your employer, the government takes out taxes, takes out all the taxes from the paycheck, and then you're left with the net pay. And with that net pay, you pay your mortgage, you pay your car payments, you pay your utilities, and you pay your student loans. What the CARES Act says, if you're going to pay your student loans anyways, you can have your employer contribute that amount that you're going to pay towards your student loans, contribute that as part of the CARES Act, and you do not have to pay taxes on that amount from your paycheck. So basically, if you don't have to pay taxes on that amount, it's going to increase your home pay, the net pay that you take home. So what you need to do is check with your employer and check with him and see if they are involved in this program, or what you can do to take advantage of this program once the CARES Act expires on September the 30th. If you're going to pay for those student loans, it would be nice for you not have to pay taxes on that same amount of money. But your employer must implement this program for the employee to participate. All right, repayment on student loans. So we're going to talk about some options on repayment on your student loans. So this first box here is loans owned by the federal government. Remember, there's federal loans and then there's private loans. So these loans owned by the federal government right now are under the protection of the CARES Act. But after the CARES Act expires, you're going to need to do one of several things: continue making your payments on your student loans. If you have good credit, you can look at refinancing to a lower rate, lower your monthly payments, changing the term, creating some flexible options for you that work within your income. And there's also some payment solutions that you can utilize: income-driven repayment, deferment, forbearance options. And we'll talk about that a little bit more in detail here in a minute. If your student loan is not owned by the federal government or the Department of Education, and it is with a private lender, then as we talked about, the CARES Act does not apply to you. So you should be making those payments on a monthly basis right now. But you still have the same options to look at refinancing the lower rates, lower your monthly payments. Your lender will have some options for you. Check with your lender and check about some deferments and forbearance to help you out with some of the payments on your monthly payments. So here's some repayment options that we are going to talk about. So you have income-driven repayment. So the income-driven repayment basically is based off your income. So if you have X amount of income, then the federal government will say, okay, this is going to be your X number of payment. So that's something that you would apply with the federal government, and they would be able to tell you what your payment is going to be based off what your income is. If you notice the three options or the three tabs up there, you got the FFELP loans, you have the direct loans, and you have the private loans. So that FFELP and direct is the federal side of things, and then of course the private is with the private lender. You notice there on the private lender piece on the income-driven repayment, anything with a private lender, you will need to get with your service provider and check with them to see what options they have under this repayment source. So every service provider is different. So for instance, if your loan was with LFI, with the division of SouthEast Bank, we have different payment options and different programs to assist borrowers and to help the borrowers if they're struggling to make the payments. And so the borrower would just need to reach out to LFI or reach out to their private lender to have that discussion to see what would be available. On the graduated repayment plan, this is one of the plans that my student loans were under once I came out of school and once I graduated. So your payments are lower at first and then they increase. So why do you think that is? The reason for that is typically when you graduate from college, your minimum salary is typically the lowest that it will be at that point in time. And then usually it will escalate over time as you gain more experience in your career, as you move from job to job or whatever it is. So as your salary and your income increases, then at that point, your student loan payments would increase as well too. So usually on this plan, they'll start pretty small, something that's really, really manageable for you. And then every 2 years, they will escalate that payment to kind of coincide with the escalation of your income. So this is really useful and really helpful for those students who graduate and just go right into to a field, maybe at beginning or a beginner stage of their career. And this helps them manage their student loans. And usually the graduated repayment plan is with the idea to ensure that your loans are paid off within 10 years. That's typically how most of the federal loan payments are set up. And that's usually why you see a lot of people moving over to a private lender at some point to refinance and consolidate, because you can typically stretch out that term for a little bit longer to help manage those payments. The extended repayment plan. This is a fixed or graduated plan, and this is a repayment option that the federal government has that will ensure your loans are paid off within 25 years. So if you get out of school and you cannot afford the payments based on 10 years, you can ask them for an extended repayment plan, and that will push that to 25 years. But one thing to note, the longer If you go from 10 years to go for 25, your monthly payment may be lower at the time, but in the long run, you're going to end up paying a lot more money back because you got interest that's going to be accruing for 15 more years than you would if you had the loan paid off in 10 years. So every situation is different. So it's definitely worth the conversation with your lender or with someone who is handling your accounts to ensure what's going to be best for you, because every situation is definitely managed differently. The next you have a forbearance. So a forbearance is a temporary postponement of a payment on a loan that is allowed under certain conditions during which interest generally accrues. So what would qualify as a forbearance? Typically, if you lost your job, if you're unemployed, a birth of a child, some sort of lifestyle change, maybe moving to a different location, different things like that would be considered a forbearance. And there's different guidelines that you can look up to see what would qualify as a forbearance. So basically what a forbearance is it would be a temporary postponement, but even though your payments are postponed, your interest will still be accruing. What that means is your interest will still be calculating and adding on to your loan. So you're still going to have to pay the interest during that period of time. And if you look on the private loan side, again, you'll have to check with your service provider to see what their forbearance policy is. On the deferment side, it's a little bit different. So a deferment is basically another temporary postponement, but what it does is the interest does not accrue. So right now you see a lot of, you hear the word deferment a lot. So I know on the bank side, we had customers during the pandemic, they would call the bank and the bank would offer these customers deferments. So what it is they wouldn't have to make their payments for 2 months, 3 months, 6 months, whatever the time was determined. And those payments would be put off to the end of the loan. And during that time, your interest there does not accrue. So that's a little bit better than the forbearance, because that way you're not having to pay interest on your student loans while you're not having to make any payments. And then last is a refinance. So depending upon the borrower's credit, you can take the 3, 4, 5, however many loans that you have. Your rates are going to vary on every student loan. Combine that into one loan, get a cheaper rate, get a lower term, and this is usually more user friendly for the borrower and easier to manage with a lower monthly payment. One thing to keep in mind right now, you might say, well, I really don't need to do any of these repayment options right now because I'm not having to make any payments right now, because of the CARES Act. The CARES Act has been in place since March of 2020. And so if you do have a federal loan, you haven't made a student loan payment probably for a year and a half. But at some point, the CARES Act will expire. And when that time comes, you're going to want to be able to set yourself up for the best possible scenario, the best possible solution at that point. And when the student loans payment kicks back in October, if it is not extended, then you'll want to look at one of these options here with your service provider to see which one is best for you, which one is best for your situation, which one will definitely help you out the most in the long run. So there's positive and negatives to everything. So you can get a short-term loan for 10 years. Your monthly payment is going to be higher, but you're going to pay less money over the long period of time. Whereas compared to something that is 25 years, your monthly payment will be lower, but you're going to pay back more money in the long run because you have it extended for a longer period of time. And the last thing I have here to kind of share with you some rates. As of right now, it may not you may not be affected by these rates because of the CARES Act. But as of July 1st of 2020, for a direct subsidized loan, the loan was 2.75%. And you can kind of see there how it escalates on the different types of loans as far as unsubsidized, a direct plus, on there, and you'll see that the APR is a little bit different than the interest rate. So like for instance, in the undergraduate, you see the APR is 2.97 versus the interest rate of 2.75. And then the direct plus, you see that the APR is 6.21 versus an interest rate of 5.30. The difference in that is the amount of loan origination fee that is charged on your loan. So when you do a loan with the federal through the Department of Education, they charge a loan origination fee anything from 1% up to 4%. If you do a loan with a private lender, any private lender, there is the loan origination fee is a 0%. So every year in July, the rates readjust. So student loans today, as of today, you see the rates are starting to go up a little bit. The interest rate is 3.72 compared to the APR 3.94. And then you can see the other categories down there. So next July, the rates will adjust again, and it could be lower and it could be higher at that point, depending on what the market is doing. You notice there, I don't have any rates for the direct consolidation. So if you go and ask for a consolidation loan for on the federal student loan side, basically what they'll take, let's, for instance, let's say you have 5 loans, and those 5 loans are all going to have different rates. One might be 2.75, one might be 3.5%, one might be 4%. They are going to take the average rate of all of your loans, and then they're going to add about a 25 basis points to that in order to consolidate your loan. Okay. Now, if you consolidate your loans on the private lender side, all right, you see down there the rate and APR would be right now around 3.5%. So there's some advantages and disadvantages to both of them. On the private lender side, also there is a 0% loan origination fee. So I'm gonna Julianne, if you want to unmute. I know you probably had a couple things you wanted to add on some of the slides here that we talked about. Anything that you wanted to say?
First of all, y'all, sorry, I'm having some camera problems. For whatever reason, my video is not working, which is kind of frustrating. But I think Chad did a good job covering everything, and we're going to open the floor for questions in just a minute. But just kind of as a tag on, it's really a great time to be reducing your student loan debt, even though you technically don't have to make payments right now due to the CARES Act. But because you're not getting any interest added to your loan right now, it's a perfect time to reduce your principal balance. And what that looks like is just being diligent about making payments on your student loan, again, even though you're not required to. There's a lot of kind of myths out there about student lending right now. And so what we assume is that loans are not going to be forgiven. You're going to have to pay them back. And so if you can just develop some discipline around making sure that you're making monthly payments, again, even though you're not required to do that right now, it's a good habit to get in for when you have to start paying them back, potentially in October. And because you're not accruing interest right now, it's a great way to reduce your principal balance.
Yeah, every dollar you pay goes directly to your principal instead of any to interest. So it's a definitely an awesome opportunity to reduce that debt and save money in the long run for sure. All right, we're gonna open it up. I don't know, Chelsea, if there's any questions or anything, or anybody has any questions.
There is a question in the chat.
Okay, if you feel like you don't want to, no question is every question is a good question. So if you have a question, I'm sure everybody else is probably thinking the same thing. But if for some reason you do not want to ask the question in this Zoom call, any additional questions you can email to answers@elfi.com, and that goes directly to somebody in our student loan department, and they will get back with you pretty quickly and give you the answer and give you a lot more information than what me or Julianne probably could anyways.
So yes, there is a question from Tanya about loan forgiveness, and so that's a very complicated question. And there's
what's the question, Julianne?
The question is, are there programs or loan forgiveness programs for people in certain fields, different occupations, or if you're getting disability? So there's not a straightforward answer, and that would be a really good question to send over to answers@elfi.com. There are some forgiveness programs, but Chad and I are not the experts on those. And so again, that would be a good question to send over. But it also, it depends on, if you're talking about federal loans or if you're talking about private loans. Typically the federal loans, they will work with you on some different payment options. If you've gone on disability and you're having an issue with paying your loan back. So it's kind of an individual situation on that.
That's a great question. A great question with a ton of different answers. As Julianne said.
There's so much, there's again, so many myths out there about student loan forgiveness. And there's a lot of, media coverage right now that there's going to be a big batch of student loans forgiven, or a portion of student loans. And when you really talk to the people that know the student loan business, Chad and I had a long conversation with some of our LFI folks yesterday. It's probably too good to be true that that's actually gonna happen. So the reality for most folks, there are probably some niche markets that maybe can look at forgiveness, but the reality for most folks is that if you've borrowed money to go to school, then you're gonna have to pay it back. And if you get into a default situation where you just decide you're not gonna pay it back, the government will figure out a way to get their money, which could look like garnishing your wages, or and so again, it's a great time during this pandemic if you are employed and have the means and the diligence and discipline. It's a great time to be paying your student loan debt back at 0% interest.
Yeah, if you kind of piggybacking off that, if you remember at the beginning on my slide presentation, there's probably over $1 trillion of student loan debt out there. And if the federal government, if the rates on average are 3-4%, that the federal government is, or the Department of Education is earning off of $1 trillion of student loan debt, that is a ton of revenue that would need to be made up if student loans are forgiven. So there's a ton of revenue that the government is bringing in with student loans. Is there any other questions out there?
Folks can feel free to unmute yourself if you have a question that you'd just like to ask out loud.
I'll kind of give you an example. I don't know if some of you guys have subsidized or unsubsidized student loans out there. Basically, what the difference between those two are, Subsidized basically means that as you have the student loans, you don't have to pay interest until you graduate. And I don't know what our mix of I don't know what our mix of attendance is as far as if they're students or parents of students or people who've already graduated and have student loan debt. But basically, a subsidized loan is if I take out a student loan day one, I don't have to pay any interest or make any payments on that until 6 months after I graduate school. And that's when my payments would kick in. That's a type of program that I kind of went through. Unsubsidized basically is you take out a student loan day one and you're having to go ahead and start making payments even while you're in school. So I would think the majority of the student loans that you guys may have out there are the direct subsidized to where you didn't have to start making payments or you don't have to start making payments until after 6 months. And student loans, just kind of another tidbit. So student loans, when you get the student loan day one, when you get the student loan, it does show up on your credit report and your credit file. So paying those student loans has a huge impact on affecting your credit standing and your credit score. So even if you have a subsidized loan and you don't have to make the payment, so on your credit report it will show that you have 3 or 4 or 5 student loans, but it will show that those are in a hold pattern or a deferment status until you actually start making those payments. So whether you and right now, if you have those loans with the on the federal side and it's under the CARES Act, if you pulled your credit, it should show that those are in a deferment status and those are not affecting your credit score right now, since the government has put a pause on those payments.